Okay. So you guys all can see my presentation here, yeah? I think so, right?
Yes. Yes.
Okay. So the paper's title is Price Transparency in OTC Equity Lending Markets, Evidence from a Loan Fee Benchmark. And it's a joint work with 4 colleagues of mine. It's a basketball team. Fábio Sereda was my student, my MA student. So this comes from his dissertation, okay? And before going to the paper per se, let me briefly talk a little bit about the equity lending market. How does it work? And I'm going to follow Duffy, Garliano, and Peterson paper. They model this market, and they model it as the following: like, there is a short seller. There are many short sellers, and this is Fernando Chag, one of the co-authors here. He looks like a short seller to me, because short sellers, they are pessimistic about the short run, and Fernando is a little bit pessimistic about everything. I think Fernando is here. Hi, Fernando. And the short seller, so it's an investor, a short horizon investor, who does not have the stock, but thinks that the stock is going to go down. What does he have to do? He has to search for a lender in the OTC market, in the over-the-counter market. And eventually he finds a lender. There is a broker here in the middle, intermediating this searching. Eventually he finds a lender. The lender is me here, I'm the lender. And the lender, usually he does not care about the short run. He is a long horizon investor, like a pension fund, or I don't know, any long horizon investor, like an index fund. And he has the stock, okay? And in general, there are relatively few lenders in the market, in this equity lending market, so that a given lender is visited many times during a day, during a typical day, by many short sellers. This has a pretty important implication, which is the following: like, the information set with respect to the equity lending market, with respect to what is the fair loan fee for that stock on that day, the information set of the lender is way bigger than the information set of the short seller, because this guy here, he's visited many times during a day. So this is important. Like, even though the short seller is really well informed about stock prices and the short run of how the prices are going to evolve in the short run, this is a really well-informed investor in general. But regarding the equity lending market, he's not well-informed. The well-informed regarding the equity lending market is this guy here. Okay, what does it happen in this situation? The short seller, he pays a search cost to find the lender in order to borrow the stock. And the short seller does not observe other transactions that are going on at the same moment. He is like in an opaque market, So he is uncertain about the fair loan fee for that stock at that moment in time. Given 1 and 2, Duffy and his co-authors, they show that the lender ends up with a local monopoly power. The lender is able to charge a high loan fee from the short seller. Because like if this guy here says no to this guy here, there is a risk, a chance that he will not be able to find any other lender in the market. So this guy has some bargaining power over this guy here. All right, and this is what the theory by Duffy, Garliano and Peterson 2002 predict, okay? And there are two empirical papers that test this theory. One is this one here, which uses more aggregate data to test this prediction here. And the other one is my paper with almost all the same co-authors of the present paper, except for Sereda, Fabio Sereda, who was not here. We use the very detailed Brazilian data from the equity lending market to show that this kind of dynamics does happen in the equity lending market. Okay, so, but this is the past. Let's talk about the future now, about the present paper. Like, we are going to study a change in this variable here, the uncertainty of the short seller about the current loan fees, because the short seller does not observe the current loan fees, what's going on in the market. And we are going to study a shock in this variable here, which will be given by a public loan fee benchmark. A public loan fee benchmark. From the time the short seller can see the public loan fee benchmark, his information set enhances. And now he's better in this bargaining here with the lender. He's better positioned relatively to his previous position. And this is what we're going to study here. And we are related to, we are going to produce empirical evidence of the effects of this benchmark here. And there is a paper, another paper by Duffy, now with two other co-authors, that predict what's going to happen in an OTC market when a benchmark emerges and when information asymmetry decreases across investors. So we are talking to this paper here now, okay? All right, so I used 10 minutes so far, okay. So the equity lending market, it's opaque all over the world. It's an OTC market. Em português, é mercado de balcão, okay? And it's also opaque in Brazil. But here in Brazil, there is an important difference, which is the following. All loan contracts, they must be registered by the brokers in the end of the day with the exchange, B3, because B3 does the job of a central counterparty in this market here. So B3 has the data of all loan deals in the end of the day, okay? So the equity lending market is opaque for participants in Brazil, as it is in the rest of the world. But here the exchange has the data in the end of the day. And so researchers may also have the data and study what goes on in this opaque market, okay? All right. And as I said before, we are going to study to try to evaluate an exogenous change in this opacity. What do I mean by that? The exchange reduced the market opacity in 2 occasions in the past. In March 1st, 2004, before that, the market was really opaque for short sellers. They had no clue about what was the current loan fee by the time they were able to find a lender. But in March 1st, 2004, the exchange began to publicize a loan fee benchmark. So a stock level loan fee benchmark began to be publicly reported on a daily basis. And this was the average loan fee over the past 15 days. So the average loan fee over the past 15 days for each stock was made public on a daily basis from this date onwards, okay? 7 years later, on March 1st, 2011, this interval here was reduced from 15 to 3 days. And what we are going to do, we are going to study this shock here. Unfortunately, we do not have data to study this shock here. Our data set begins in 2008. We're going to focus on this change here. This is the communication of Bovespa at the time about the change. So it reads like follows. We hereby inform you that as of March 1st, 2011, the average fees on the loan deal will be published on the internet based on a 3 business day period per security. At present, the published period is for 15 business days. So this was the change. And they are clear about their goal. Like they say, we highlight that the purpose of the change is to make the securities lending service ever more transparent. So to reduce the opacity in the market. In order to attract more security lenders, maybe smaller lenders, borrowers, and to meet the demand of institutional investors. So like this is not so clear, this go here, but here it's pretty clear, like they want to do that to make the market, the equity lending market more transparent. Okay. And indeed, like reducing the moving average window from 15 to 3 days did increase the benchmark precision mechanically, right? So here I have an example. I have a stock, JBS, and the black line here is the average daily loan fee across all deals on the day, for each day. This is the black line. And so we have a period here, some months of a pretty stable loan fee, and then it becomes more volatile, the black line. And the blue dotted line here is the 15-day benchmark. Simply like the average of the daily loan fee in the previous 15 days, right? And the red line here is the 3-day benchmark, the average of the daily loan fee over the previous 3 days. And like short sellers, this is important, short sellers were not able to observe the daily loan fee. They had no clue on this. Before the change, they were able only to observe the blue line. And after the change, they got able to observe the red line. And like this picture makes clear that in periods of stable loan fees, there is not much a difference. But in periods of volatile loan fees, which are the relevant periods for short sellers, it's pretty different to observe this 3-day benchmark compared to the 15-day benchmark. Okay, this is the cumulative prediction error of a guy trying to nowcast the daily loan fee using the 15-day benchmark and the 3-day benchmark. Okay, and it's important to mention also that since short sellers did not observe the daily loan fee, they were not able to estimate fancy models, fancy prediction models using past benchmarks. What is going on? Some red lines appeared here. It was not me, I swear. So all they had to observe here was the benchmark. Okay, so can you guys see these red lines here?
Yes, Bruno. I don't know what's going on also.
So let's move on.
Yes.
Yeah, let's move on. Okay. So the effects. Okay. What were the effects of this benchmark change? So like from these two papers here that I mentioned before, we expect loan fees to go down because the bargaining power, the information set of short sellers enhanced, so they were able to better bargain for loan fees in the searching process. So we expect loan fees to go down. We also expect a stronger effect for short sellers with worse information. So short sellers really well connected in the market. The market was not that opaque for them before the benchmark change because they were already well connected. So the benchmark change for them was less important than for a short seller poorly connected, right? So we expect stronger effects for short sellers with worse information. And naturally, we expect loan fee dispersion to go down and loan fee intraday dispersion, right? However, in a more complicated model, we could think that results could be unclear. Maybe lending activity could be negatively affected by the change and retract, because now lenders, their relative bargaining power was diminished, so maybe they could retract their lending activity. For instance, here we have a story, we could have the following story: borrowing demand from short sellers for stock is a strong signal of future underperformance. And then with lower loan fees, some lenders, maybe the ones with shorter horizons, could decide to sell their stocks instead of lending, given the lower loan fees. So we could find a negative effect from this change, but we do not find it. As I will show, we do not find it. What we find is exactly what is predicted by the usual models. We find that loan fees go down. We find different, stronger effects for short sellers with worse information. We find loan fee dispersion going down as well. Data, so it's exactly the same data set used in our previous paper. It's the complete activity in the equity lending market from 2008 to 2011. And in our baseline analysis, then we have some robustness exercise, but in our baseline analysis, we focus on the 2-month period around the benchmark change. So we focus on these 2 months here, like February 11, March 11, the benchmark change was March the 1st. So we have 1 month before the change, 1 month after the change. Okay. What do we find with respect to loan fee level? First, I will draw a figure here which is going to show the following. So for each stock S and day T, we compute this variable here, which is the equal, both the equal and the volume weighted. So for each stock S on day T, we compute the average loan fee, both equal and volume weighted. So this is the average loan fee of the loan fee. So this is the daily average of the loan fees considering all loan deals of stock S on day T. So this is the variable for each stock S and day T, the average loan fee. We compute this variable here, which is simply, we standardize this variable, this average loan fee, within each stock, because different stocks, they have different levels of loan fee, and then we want to combine them all in a single plot. So we standardize this variable here. So now this variable is in terms of standard deviations around the stock specific mean of the average loan fee. Okay. So we have a panel for this variable here, a value of this variable for each stock on each day. And what we do here, we compute both the average and the median of this variable across all stocks. So for each day, we will have an average of this variable here and the median of this variable, so that we can plot 4 graphs like these. So like this, for instance, this dot here, it is the average loan fee. It is the average loan fee. It is the average loan fee across, it is the average loan fee across all stocks on this day here. And the daily average loan fee is volume weighted. Oh, I hope this is clear. So these are the 40 days around the benchmark change. And let's focus on this graph first. As we can see, the average loan fee in the market, this is a measure for the market loan fee. It was going around here, and then after this day here, it seems to go down, right? It was kind of stable here, and then after the benchmark change, it seems to go down. What if instead of computing the daily average loan fee volume weighting, we compute it equally weighting across all deals for the same stock on the same day? The same thing happens. What if instead of computing the average of the average loan fee across the stocks, we compute the median of the average loan fee across the stocks, volume with the average volume weighted? Kind of the same thing. What if we compute the median of the equally weighted average? Kind of the same thing. So, and effects seem to be like economically important, like half a standard deviation, yeah, okay. It's important to say that we should not expect an immediate effect right after the benchmark, because people, short sellers, they have to learn about the benchmark, and they have to learn about the change, and they have to learn about how to use that to bargain with lenders. And so it's natural to see a trend, a downward trend here after the change. Okay, but we want statistical significance, and then we run, let me see the time. So I have 15 more minutes, okay? So we run a deal level regression. A deal level regression with all loan deals within this 2-month period. We run the following deal level regression, where what is FISTK? FISTK is the standardized within stock so that we can interpret coefficients in terms of standard deviations. Is the standardized within stock loan fee of deal I, so this is a deal level regression of deal I, of stock S, closed on day T, by short seller K. This is the loan fee paid by short seller K when he was borrowing stock S on day T in this deal here. Okay. After T is a dummy variable that equals 1 from March 1st, 2011 onwards to capture a possible change in levels of the average loan fee. T is a linear time trend. Maybe loan fees were going down during the whole period. We do not want to confound that with the benchmark effect, so we can control for a time trend. And X are control variables related to stock S on day T, like past returns, past volatility, like Bollinger Bands, variables that may capture changes in the market for the stock in this period. And this is important. This is something that we can do. This is a different constant for each pair stock short seller. So it's a stock investor fixed effect. So we are going to compare within the pair short seller stock the possible effect of the benchmark. This is something nice that we can do because we have we can track short sellers over time. We have a fake ID for them. So this is the result of the regression. Let's focus here on the last column, which has all controls and has the investor stock fixed effect. So in the period, we had 51,000 loan deals within this 2-month period, okay? And here we find that the average loan fee after the change, so the average loan fee in March is 0.25 standard deviation below the average loan fee in February. Controlling for a possible trend, controlling for these stock day variables, and with the investor stock fixed effects. Actually, this coefficient here, without controls, with different fixed effects, it is pretty similar. It is pretty similar. And this is a strong effect. 1/4 of a standard deviation, like it's a strong effect. And then we go forward in a kind of a diff exercise. Was the difference different for different investors? So this is our paper, Chag, Deloso, Gennaro, and Giovannetti, according to our previous paper, short sellers who are poorly connected end up paying higher loan fees in the market. This is basically what we show in the previous paper. The new benchmark informational gain should be greater for poorly connected short sellers. So we may expect the benchmark effect to be stronger for them, for these poorly connected short sellers, right? And then to test this, we interact both the trend variable T and the variable after with this psi letter here, which is a dummy variable that identifies poorly connected short sellers in the sample, okay? And then we use 3 measures of poorly connected short sellers. Of course, they are correlated measures. There are different ways to measure the same thing, how poor connected a short seller is. The first one, we split short sellers into 2 groups based on the same network-based variable that we use in this paper here, which is a variable called borrower connection. The higher this variable is, the better connected is the short seller. So we have well-connected short sellers in one group and poorly connected short sellers in another group here, 2 groups. And then we also split short sellers according to the total number of loan deals that they had made since 2009 until the benchmark change. Another way to measure how well informed is a short seller about the equity lending market, right? And lastly, we split them simply according to their type, individuals and institutions. We have almost 4,000 individuals in this period and almost 4,500 institutions. Oh, sorry about that. We have 4,500 short sellers and 3,750 short sellers are individuals. So we have 2 groups here, individuals and 800 institutions. Okay. So this is the regression output with interaction. And what matters, let's focus here when we use the borrower connection variable to split short sellers. Results are pretty much the same because these variables here, they are naturally correlated. And so here we have the average loan fee after the benchmark change compared to before the benchmark change for a well-connected short seller. So it was diminished by 0.2 standard deviations for a well-connected short seller. They also benefited with the benchmark, but poorly connected short sellers benefited much more. The effect was almost 2 times the effect for well-connected short sellers. So for a guy with psi equal to 1, which are the poorly connected ones, it's more than 0.3 standard deviations. Here it's actually, it more than doubles. And here it also more than doubles. So the effect seemed to have been much stronger for the ones we expected the effect to be much stronger, right? Okay, so loan fees for this presentation here, we are done in the paper, we have more stuff, but let me move forward to what happened to the lending activity concentration. This is an issue. What's going to happen with lenders after their bargaining power is reduced? And one hypothesis was that maybe small lenders with this benchmark became more comfortable with getting into this market. And maybe the concentration in the lending activity could have reduced it, maybe. And that's what we find. Like, we compute for each stock day the Herfindahl index regarding lenders. So it goes from 0 to 1. And it's 1 if all lending activity is concentrated with one lender, and it's very small if it's really the lending activity is spread out across many lenders, right? Okay, what we find here, and then we can compute the Herfindahl index considering the number of deals of each lender within each stock day, or instead of number of deals, we can use the volume. So we do both. What we find here is that it seems that the market, the lending market, became less concentrated right after the benchmark change, right? When we consider the number of deals, the effect is more significant than when we consider volume, but it indicates that the lending activity may well have become less concentrated with the benchmark, which is something maybe nice. And then we look at the equilibrium variable, like the loan quantity, the variable of equilibrium, the loan quantity, demand, supply, the final quantity. And then it seems to have increased in March compared to February, controlled for the trend, controlled for these stock-specific variables. Here is stock fixed effect. So here it's not a deal level variable anymore. This is not a deal level regression. Now we are talking about the loan quantity within a stock day. So it's a stock day panel. So we cannot use here investor fixed effect. So we have here stock fixed effects and some controls. And it seems that March compared to February, controlled for this stuff, loan quantity was 0.25 standard deviations higher. We do a number of additional exercises in the paper. It's on my webpage. You guys can go there and download it. We use narrower and wider windows around the benchmark change. We do a number of placebo exercises. We run the same regressions on using all other months which had no benchmark change. Yes, in 2014, so 3 years after this change here, there occurred another change when the benchmark window was reduced from 3 to 1 day. And then we evaluate also this change here. We find here that the gain in terms of precision, in terms of mean square error for the short sellers to now cast the loan fee, here the gain was really small, and we find no effects in terms of loan fees here. So we can see this as a placebo exercise too, I don't know. And we do other analysis, like we look at loan fee dispersion, the entrance of new lenders. And this is nice too. We tabulate the existence of loan fee benchmarks in other countries. And we find that only in 3 countries they have public loan fee benchmarks: in India, in Singapore, and in Taiwan. Okay. And so like, it may be good for the market to have a loan fee benchmark, and many countries do not have loan fee benchmarks. It's not easy to have a loan fee benchmark. As I said in the beginning, here in Brazil, we can have it because the exchange observes all loan deals in the end of the day. So in the US, for instance, the SEC does not have all loan deals in the end of the day. The loan deals, they are kept within the brokers, but maybe SEC could ask the brokers to inform them the loan fees and in order to construct a benchmark. It may well be possible, I don't know. Okay, so conclusion. On March 1st, 2011, the equity lending market became less opaque in Brazil, more transparent, right? Because loan fee benchmark became more precise due to the reduced window, moving average window. We document the following. We document lower loan fees, stronger effects for poorly connected short sellers, enhanced lending activity, and then, as I just mentioned, a possible and simple and expensive policy implication for the US, for example, would be the following. Like, there is no public available benchmark there. Brokers could report the loan fees of their deals to the SEC, and SEC could publish a loan fee benchmark. Something that I did not mention in the beginning, it's good to have low loan fees in the market, because then short sellers, they become less restricted with lower loan fees, of course. And short sellers' activity is very important for market efficiency. So a benchmark, in the end, it may enhance market efficiency. Okay. So that's it. Thank you very much. Yeah, 44 minutes. Thank you.
Yes, very sharp. Thank you, Bruno. I received so far two questions. I will open first for Rafael Schioser to ask his question, and then for Giuseppe. If anybody else want to ask a question, just let me know and I will open the mic.
Mm-hmm.
Okay.
Is Rafael talking? I cannot hear
No,
him.
no, not yet. I have.
Okay.
Now,
okay.
Now he's on mute.
Okay.
Oh, or not. Just a sec. Unmute.
Okay. Okay, now I can unmute me. Okay. So thank you, Bruno, for the presentation. Very nice.
Thank you.
I have a very simple question. Why do you need a time trend in such a short period? And by looking at the coefficients you show, I seem to see that they're kind of offsetting each other, right? So the after coefficient is sort of offsetting the time trend. So if you take out the time trend, you probably lose, at least lose some magnitude in your after coefficient. Right? So
yeah.
Why do you need a time trend? I'm not.
Yeah. So like, even though the period is a short one, maybe loan fees were going down across the whole period. And then if we do not have a time trend, we may say that it was a change right after the benchmark, but it was not. But I agree with you that it's not clearly necessary a time trend. If we do not include the time trend, results are pretty much the same. And this is really interesting, Rafa, because our referee asked us to report results without the time trend. So I think maybe you were the referee.
Makes sense.
But you are right.
Okay. You want to ask something else, Rafael? Okay, so I will open Giuseppe Trevisan mic, and then he can ask his question.
Okay, thank you so much. Very nice presentation, Bruno. I think I still don't get how you define those sellers for the when you do the diff in diff, when you interact with the after a dummy and the control group to compare the treated and control groups.
Okay, in our previous paper, actually, let me begin with the simplest answer. Like one way we split short sellers into two groups is using their types. So in one group we have individuals, and in another group we have institutions. So that's it. And then, since individuals in general should be, on average, less well-informed than institutions, we expect them to be greater affected by the benchmark. So the simplest way is using their types, individuals and institutions. There is another way where we use our borrower connection variable, which is a network it's a kind of a network variable that we used in our previous paper. So that's why I didn't explain this variable today. Sorry about that. But it's a variable that measures the centrality of the short seller in the market. How well connected the short seller is in this equity lending market. Capturing, so like individuals, according to this variable, individuals are worse connected than institutions as expected. So it's almost the same as individuals and institutions in a simple way. Did I answer your question?
Yeah, okay, you answered, but I still, my main concern is because, for example, in your first definition of these two groups, individuals versus institutions, they are actually different even before this shock, because I suppose that, for example, institutions are well informed about.
Right, perfect.
You know,
perfect,
so
yeah.
for example, maybe that's why you are getting because you expect that the coefficient would be larger than that you found, right?
But what we find is that before, in February, they were more different than in March. Like
yeah.
in February, individuals used to pay, let's say, a loan fee of 2% per year, and institutions a loan fee of 1% per year. And then in March, we find that individuals began to pay a loan fee of 1.5% per year, and institutions of 0.9. So the difference decreased.
Okay.
Yeah.
Okay. Because I just worried because of the endogeneity of comparing like individuals versus institutions, you know.
Mm-hmm.
But
okay.
yeah, maybe you are right.
Okay.
You're getting okay. Thank you so much, Bruno.
Sure.
Luis Sacramento would like to ask a question, right? Okay, let me, Luis, where is Luis here? Okay. I'm not, okay. 1 sec, please. I'm not finding the way to unmute Luis. If you have access to his question, would you mind to ask directly to Bruno?
No, he didn't send a question, so he just mentioned that he wanted to ask a question.
Okay, sorry. So
he just wrote it down. He's asking him, do you discuss in the paper or think that the reduction in market opacity is good or for both parts? I mean, for lenders the smaller loan rates might make them less eager to lend? Like, what is the effect on the lenders?
Can you say that again? Sorry. Can you repeat that, please?
You discuss in the paper, think that the reduction in market opacity is good for both parts, so both for lenders and borrowers.
Yeah, okay. Well, yeah, what we show, I think, is that it was good for borrowers overall. And with respect to lenders, we show that what we show is only that the lending activity became less concentrated. We do not show that actually, like for the lenders who were charging high loan fees before the change, I think the change, like, it may have been, I'm not sure, like maybe I think for these big lenders who were able to charge high loan fees beforehand, the change was not good. Maybe, I'm not sure about that, but we do not say in the paper that the change was good for lenders. We say the change was good for short sellers in terms of they were able to pay lower loan fees overall, stronger effects for poorly connected short sellers. For lenders, we say that maybe the activity became less concentrated, but good or bad for them, not clear as well. Not clear.
Mauricio.
Okay, so hey Bruno, thank you for the presentation, first of all. I would like to ask you some more practical questions about the differences between the US market and the Brazilian market. Regarding the regulations in the lending market, I wanted to know how is the capital requirement in Brazil compared to the US? And because I think the US, they have more regulations. And I would like to know, how do you think these differences can impact in the loan fee? Because you were saying that the Brazilian market seems to be more clear than the US market, but at the same time you have more regulations within the US, and so I would like to know how the regulations can impact on top of that.
Can we be more clear about, like, what do you think the different regulations are? Because in my understanding, they are pretty much the same. There is one big difference, which is that here in Brazil, B3, which is our exchange, is the central counterparty, deals with the central counterparty risk, which this does not happen in the US. The other difference I know is that here in Brazil, when you borrow a stock, your margin has your capital requirement. You can deposit your capital requirement in bonds here in Brazil. In the US, it has to be in cash. Other than these two differences, I'm not aware of any other. Do you have any other in mind?
I don't know exactly what are the laws in Brazil, so this is why I'm asking.
Okay, yeah, I think
I just wanted to know how different it is, and
I think it's pretty much the same.
Okay.
I think these are the two important differences. So maybe in Brazil, the counterparty risk here in Brazil is, maybe it's small than in the US, the counterparty risk, because we have the exchange dealing with that in Brazil. And the other difference is with respect to your margin call. Here it's bonds, there it's cash, but this is not, like, I think it's not an important difference.
Okay, I was thinking about the capital requirements for the brokers. They need to save money. I mean, if they receive capital requirement, they cannot use this money. So I want to know how this could impact the business. if the brokers start needing to having more capital requirement, they I imagine that they would start using higher loans, but yeah.
I don't know how to answer you properly. Like I would have to think more about that.
Bruno, may I ask you, may I try to help in this answer?
Sure. You are
so in Brazil, we have the end beneficiary model. So the margin, the collateral is required at the individual's level. So if the margin increase, the broker itself is not directly impacted, but the final investors. So the broker itself is not more or less impacted in case the exchange increase the margin requirement.
Okay, makes sense. Okay.
Do you think that this has some consequence in terms of like external validity and stuff like that?
No, I was just thinking if the US brokers had more capital requirement, I would expect that they would ask for more loan fees, for higher loan fees.
Okay.
And
like loan fees in Brazil, they are higher than in the US. That I know.
This is a question of liquidity. I don't know what your thoughts about.
Yeah. It's hard to tell.
Okay.
Thank you.
Thank you.
We still have time for one final question. No one? Okay. I will open the mic, Andre. Just a sec. You're clear to go, Andre.
Okay, so hi, Bruno. How are you doing?
Hello, Andre. How are you?
Good. So I have a few questions. So some of them are clarifying questions. So one is about disconnectedness variable. Probably you have talked about this variable in another paper. So I wanted you to talk a little bit how this variable is constructed. Okay. So the second question is about the number of lenders and borrowers. It was not so. Could you measure that the number increased after the change? And then the final question is about the efficiency of markets, because one of the things that you want to say is that efficiency increases because of the decrease in the loan fees. But can you have any measure in which you say that efficiency really increased? So
okay, great. Okay, so the first question, like the connectedness, this variable, we construct the variable following the equity lending market for each market participant, because we can track them over time. So a short seller will end up being well connected in case he is an important client of a broker, an important client in terms of number of past deals. So the short seller is going to be well connected if he is an important client of a broker, who in turn has a strong relationship in terms of number of past deals with a lender, who in turn has a large market share of the lending market for that stock. So in this case, if the short seller has a stronger relationship with a broker, which in turn has a stronger relationship with the short seller, who in turn has a large market share for that stock, this short seller is going to be, we're going to have he will have a high borrower connection value. In turns, either one of these links gets weaker, like either the market share, or the relationship between the broker and the lender, or the relationship between the short seller and the broker. then the value of this variable goes down. So like on the one hand, we have a guy who has never made a loan deal before, and he goes there to make the first loan deal. He will have a zero borrower connection because his relationship is zero with everybody. Like on the other hand, we have a guy who does a lot of deals, and I hope this is clear. Like it's a kind of complicated variable because it depends on relationship and market shares of many participants, and it evolves on time. It's investor, stock, day specific. So it changes over time. It changes across stocks for the same short seller. Okay.
Yeah. So I understand the intuition, but then you use the numbers for that. You use the number of maybe transactions that an ID has. Okay.
That's it.
And so on. Okay.
As simple as that. Yeah.
Okay.
Yeah. It's complicated in terms of calculation, but the idea is really simple. Like it's just the numbers of the market. Okay, so the second question
about the number of lenders and borrowers. So you could,
yeah, we do not look at the number of borrowers. We can do that for sure. Number of lenders, we look at the number of lenders, but what we report is the Herfindahl index for lenders, which in a sense is better than the simple number because we have number and market shares. But we look at the number and they increase, the number increase, and the Herfindahl decreases. What I showed today was only the Herfindahl. But number of short sellers, we do not look at it. We have to look at it. Thank you.
Okay.
Third question.
A measure for efficiency, if you could.
Yeah, sure. Yeah. We try to do that, but since we are constrained to a small window across around the event, we so far, like we do not have any robust result. Results, they are not that robust. If we change some things, the results, they change a lot probably because to measure price efficiency using a very small time frame is something not easy to do. But the referee asked us to do this. So we have been working on this. Even though I believe the empirical exercise is not ideal for that because we have only one date and a narrow window around that date. So, but we are working on that. So.
Okay, so I'm not the referee either, by the way. Ayel and I, we are not the referee. Okay, thank you. Nice paper.
And by the way,
Sure.
André will be our next speaker. We have the 22nd of May. We will have André speaking about effects of firm cash holding on monetary policy. Will be again at the same time, and we hope to have all you here again. So, who you'd like to make the final comments?
First, thanks a lot to Bruno. Excellent presentation. I guess like one thing that I would like also to get from all of you that participated today is feedback on how we did it. I guess we worked very well. But if you have any comments or anything that you would like to change or suggest changes, please let us know. And once again, thank you, Bruno, for the excellent presentation.
Thank you, Alan, for the invitation. Alan is nice.
Thank you, everyone. See you in 2 weeks. Bye-bye.
Bye.